I feel like I should have some kind of dance or something as people are walking in. I'm not going to dance for you. Okay.
It's good I can see you.
Yeah. Otherwise, this would be very weird, wouldn't it?
Yeah.
Just two people staring off into the distance, or one person, I guess, if you can see me, into the void of nothingness as we wait for attendees to the Microstructure Exchange to roll in. We were tapering off, and then there was a burst of more people coming in.
Yeah, I actually can see them.
Oh, okay. I'm giving it to the attendee member, the audience member, so that they know what's going on. Okay, I think it's like mostly tapered off for right about now. Okay. Good morning, everyone from Oregon. If it's not your morning, I guess I don't care that much. So welcome everybody to the Microstructure Exchange. I'm Cameron Pfeiffer. With us today we have Xiong, and she is from HKUST, which is a whole bunch of letters that I should have memorized beforehand. Before I turn the floor over to her to see this incredibly interesting talk about secret and overt information acquisition, I wanted to go over kind of the Q&A rules. So basically, we're going to have clarification questions be added in the Q&A as we go along. So if you can type in your question in the Q&A function, there will be two pre-selected stops that Yan will have, where I'll read the clarification questions to her. And then towards the end, the last 15 minutes or so is going to be voice Q&A, so you can raise your hand and we can do you can talk to Yan directly. And Yan has agreed to stay on a little bit if we have questions going on after.
Yeah.
We'll kind of play that by ear. Okay. And the organizing committee is noting that I'm quite rude for not caring about your time zones, especially because Yan is here very late in her day. Okay. Thank you, Yan, very, very much for coming along. The floor is yours.
Okay, thank you, Cameron. Actually, good night, everybody, because I'm now in Hong Kong, so it's quite night time. And the paper I'm going to present today is titled Secret and Overt Information Acquisition in Financial Markets. So this is a joint work with Liyan from U of T, and he is also in the audience. Let me start with the motivation of this project. So we know that information acquisition is one of the key decisions made by many investors in financial markets. And the existing literature usually take investors' information acquisition as observable. So by observable, what I mean is that they assume that the amount of money spent on acquiring information is observable to other market participants. And so the precision of the acquired information is observable to other market participants. But in many realistic situations are featured with secret information acquisition. So for example, for a fund, the coverage and the depth of the in-house research is usually unknown to the public, to the outsiders. And information purchase is a good way to acquire information, but the client base of a data vendor, like the one which sells the satellite images, it's confidential. And some sophisticated investors, they often go great lengths to hide and erase their footprints, which make their information acquisition activities even more secretive. At the same time, we observe some interesting transition from secret to overt information acquisition. Some cases are as follows. So in Shenzhen Stock Exchange in China, they have a mandate to require all the listed firms to disclose the site visits. Okay, so in that way, those institutional investors' corporate site visits become more transparent. And the corporate site visits are important ways for institutional investors to acquire information. And in the example of SEC, so they publicize the AdGuard downloading files. So based on the disclosed IP addresses, we can infer what would be the downloading behavior of a certain institutional investors. And so we can infer what would be the precision of their acquired information. And the MiFID II in Europe, they require the European funds to unbundle the research costs from other costs. And this unbundling practice can make us observe their information research costs, so better infer their information acquisition behavior. So those are the changes due to regulations. At the same time, we observe the changes from secret to overt information acquisition due to technologies. So now we live in an online world, and everyone inevitably live behind a trail of digital footprints. So the investors' news clicks can be tracked. So that's also one case we may transition from the secret to overt information acquisition. So this is a focus of our paper. We want to understand the secret and overt information acquisition and their implications for financial markets. And the observations I just mentioned raise a set of interesting research questions. So for example, how will an investor behave differently when their information acquisition becomes overt? And what are the aggregate implications for market quality, like liquidity, price efficiency? How much information will they produce before and afterwards? And if an investor can make her own choice about whether or not to make her information acquisition overt or secret, to hide or to publicize it, what will be her choice? So to answer this question, to understand the strategic effects of this observability issue, a natural starting point is CHAO 1985. And that's what we do. So we built our model based on this classic model, CHAO 1985. The key departure we take is to allow investors to engage in unobservable information acquisition. So I will be more clear about what we mean by unobservable information acquisition. So here's a main finding of our paper. So the first set of results, we compare a secret economy to an overt economy. So in a secret economy, every investor is a secret investor. No one else can observe an investor's information acquisition. Whereas in an overt economy, all investors, their information acquisition behavior is observable. Or put it differently, the precision of their private information is observable to other market participants. So this is what the traditional model approach usually take, the overt information acquisition case. Now, compared with the secret market, we find that the overt market can produce either more or less information, depending on the interplay of two effects. We call that pricing effect and competition effect. So intuitively, for investor, once her information acquisition becomes observable, she needs to take into account what will be the potential response from other market participants. So we need to deal with the strategic interaction between investors and the market makers. So we call that pricing effect. And the strategic interaction among investors is called competition effect. So for an overt investor, the competition effect tends to encourage an overt investor to produce more information. And the intuition is as follows. So as an overt investor, I know everyone else can observe my information acquisition behavior, can infer the precision of my private information. So by acquiring more information, I show to everyone else, all the other investors, that I'm more informed guy, and now I will trade more aggressively on my private information. So that can force others to trade less aggressively on their own private information and gaining me profits. So this competition effect can encourage an overt investor to produce more information. But the pricing effect can work in the opposite way, especially when we don't have many investors. Then the pricing effect tends to make an overt investor to produce less information. So now the overt investor cares about what will be the potential response from the market makers. If I produce more information, market makers understand that they are faced with a more informed investor. So they will adjust the pricing schedule to a steeper one. And that can hurt me, can reduce my profits. So that effect may make me produce less information. So overall, whether the overt economy leads to more or less information depends on the interplay of the two effects. Competition effect has been documented in the IO market, but pricing effect is novel to the financial market because it deals with the interaction between investors and the market makers. So that's the first finding. The second is that we go further to allow the investors to make their own observability decisions. So an investor can choose whether or not to become an overt or secret investors. And what we find is that when they can make such decisions, they often fall into a prisoner dilemma situation. So that's the second finding. And finally, we provide a parsimonious framework to think about this observability issue or transparency issue. And that can allow us to speak to some modern policies or empirical issues. So that's the big picture of our paper. It's related to three streams of literature. The first is the vast literature on information acquisition in financial markets. So information acquisition, we believe, is one of the most fundamental issues in finance research. And we contributed by studying the secret information acquisition and its effects. And we look at the multiple strategic traders. Also, our paper is related to the unobservability issue paper in IO markets, and it's related to the transparency, the literature on transparency. So transparency can take many forms, and we look at a new dimension of transparency, the transparency of information acquisition, okay? So I will introduce the model setup before answering the clarification questions. So model setup. So we start from a very general model setup, and this setup is general enough to nest all the subsequent discussions. There is a risky asset. It has the terminal value V, so we normalize the value to be a standard normal distribution. There are three groups of agents in this economy. J of them are strategic investors, risk neutral, and a fraction mil of them are overt investors. The rest are secret investors. Again, I will be clear about what are overt and secret investors. So the rest of the agents are quite standard. We have noise traders and we have market makers. So this is a three-dated economy. On date 0, this is an information acquisition stage. All types of investors, overt or secret, they will make the information acquisition decision simultaneously. And after that, the overt investors will credibly announce their information precision to the public, whereas the secret investors will just remain secret about their information acquisition. So this is the information acquisition stage. This is our key departure from the standard kind model. And the rest part are quite standard. So on T1, this is a trading stage. The investors will observe their private information, the realization of it, and then investors and noise traders submit orders, market makers set a price. All uncertainty will be realized in the end and everybody consumes. So this is a very simple framework. Now let's look at the details of the model. On T0, the information acquisition stage, the investor J can spend some resources to acquire a private information. The private information is modeled as the fundamental V plus some noise EJ, okay? So what the investor J can choose is how precise this private information will be. The more precise information, the higher HJ, the more resources it will cost. So we just assume the cost function to be a linear. And the result will be robust if it is a convex increasing function, and as long as there's not a high fixed component in it. And now is the key departure. So there can be two types of investors, the overt one and the secret one. If this investor is overt investor, then her precision, information precision, HJ, is observable to all the other market participants. Whereas if she is a secret investor, then HJ is unobservable. So here, this notion of observability is quite a standard in the corporate finance literature. So for example, if a firm, we said like the firm disclosed the R&D expenses, then we say, okay, the outsiders will better learn the R&D behavior of this firm. Similarly here, remember the MiFID II example? So the MiFID II required the European funds to separate, to unbundle the research costs. So by disclosing the research costs a fund incurs, okay, by disclosing the total cost, and based on this assumed cost function, we can infer what will be the precision of this fund's private information. So this is our approach. It's more of a imperfect information modeling approach, okay? So that's information acquisition stage. And the trading stage, the investor J will observe the realization of her private information, and she will place the market orders to maximize the expected profits. And here, in the information set, we put the precision of the overt investors in the information set to emphasize that those overt investors' information precision is public information. It is known to everyone else. And again, market makers observe total order and set the price according to all the available public information. So we focus on the symmetric perfect Bayesian equilibrium. It's a symmetric, meaning that the same type of investors, overt or secret, they will adopt the same information acquisition strategy and the same trading strategy, okay? So finally, I will use one tree to illustrate the structure of our game. So in this example, we plot the game structure of two investors. So one is an overt investor, two is a secret investor. And to plot the tree, we assume that the information precision is discrete. So investor can decide either to acquire a high precision signal or low precision signal. And the blue parts indicate that the two nodes are in the same information set. So at this information acquisition stage, you can see 1 and 2 simultaneously make their information acquisition, whether to acquire a high precision or low precision signal. But afterwards, since 1 is an overt investor, so she will credibly announce her information precision to the public. So afterwards, people know, okay, 1 acquires a high precision signal and 1 acquires a low precision signal here, but nobody knows what is the information precision of investor 2. So this is a simple illustration of our game. I think I will stop here for Q&A.
Okay, so we have one question that Liyan talked about a little bit already in the chat here, which is basically about the distinction between portfolio investment and information investment. And Liyan said, no, we only focus here on information investment.
Yeah.
Did you have anything you wanted to add to that maybe, or no?
Yeah, so that speaks to the third related literature. I list the portfolio investment and information investment. So in our view, an institutional investor typically have two types of investments. One is how to allocate the money in the portfolio, and the other is to spend resources to acquire information. So our view is that the literature treats the two types of investments asymmetrically. So they usually think portfolio investment is secret. So, but they treat the information investment as overt. And So what we do is that we challenge this view, and we also study whether information investment is overt or secret, and study its effect.
Cool. That's all the questions we have so far. So I think
Okay,
we can
good.
proceed.
Okay, so far I introduced the model setup, and here's a roadmap for the rest of the talk. So I will decompose the talk into two parts. First, I will introduce the economy with exogenous transparency. Exogenous transparency meaning that so whether an investor is overt or secret is exogenous given. So specifically, we will compare two economies. Economy where all investors are secret investors versus the economy where all investors are overt investors, okay? So by comparing the overt case with the secret case, we can study the strategic effects of the information acquisition transparency. And also this exercise allows us to speak to the mandates that require such transparency. Remember, we have the Shenzhen Stock Exchange regulations, and we have SEC, the Edgar downloading public. So, and another dimension is that when we do this comparison, we first look at the economy with only one investor. So by studying this monopoly case, we can clearly isolate the interaction between investor and the market makers. So this allows us to look at the pricing effects exclusively. And then by moving to the oligopoly case, we introduce another strategic effect, the competition effect. So we further study the interplay between the pricing effect and the competition effect here. So that's the first part. The second part is that we make the transparency decisions endogenous. And for tractability reason, we only focus on two investors. So 1 and 2, they can choose whether or not to make their information acquisition overt or secret, okay? So what we find here is that they usually fell in a prisoner dilemma situation. So that is the roadmap for the future talk. So let's look at the first part when we have exogenous observability. Sorry for the crowded slides, but what I want to emphasize here is, so in this monopoly case, we only have one investor and the market makers. So the key difference between the secret information acquisition with the traditional overt information acquisition cases is as follows. So in the secret case, the market makers cannot observe the actual information acquisition behavior by the investor. So they can only form a belief about it. So of course, in equilibrium, their conjectures, their belief must be correct. So they hold these conjectures, and when they set the price, the key is that the pricing rule, the lambda, does not adjust with the actual information acquisition decision. So it only based on their beliefs, their conjectures. Whereas if we have an overt information acquisition case, then the pricing schedule set by the market makers will respond to actual information acquisition by this investor. So this is the key difference between secret and overt information acquisition. And as you can see here, if the market makers do not respond to the information acquisition decision by the investor, then the investor does not need to worry too much about the potential response from the market makers. So that means that they may acquire more information without worrying that the market makers set a steeper pricing schedule that hurt her profits. So we immediately get the results that more information should be produced in this secret monopoly case. And to look at it from another perspective, to look at it from the perspective of the overt investors, we can think in this way. So this is the information precision by the overt investor, and we check how this information precision choice affects her profits pie, okay? So it can be decomposed into two parts. The first part is the standard trade-off. So if this overt investor acquires more information, she can have a better forecast about the asset fundamental and trade more accurately, gaining more profits. But at the same time, she needs to incur more costs. So this is the standard trade-off there. It is there in both secret and overt economy. The second term, which we call pricing effect, it only persists in the overt economy. So this pricing effect is only there in the overt case. So what it means is that as long as this overt investor acquires more information, the market makers will respond by setting a steeper pricing schedule. And that can make a lambda at the disadvantage for the overt investor. So that can reduce the profits of the overt investor and reduce her incentive to acquire information. Okay, so we got the first set of results. Compared with the secret economy, the overt market produced less information in this monopoly case. And the further we can talk to the market quality, we look at the price efficiency and the liquidity. So intuitively, if less information is produced in the overt market, the price will be less efficient. And if less information is produced, the market makers are faced with a less informed guy, so the market liquidity can be higher. So this is a monopoly case. Next, we move on to the oligopoly case, when we have more than 2 investors. So compared with the oligopoly case, now we have another strategic effect, the competition effect. So the competition effect is always positive, meaning that for overt investors, this competition effect will induce her to acquire more information. So the intuition is as follows. If this overt investor acquires more information, other investors will respond by trading less aggressively because now they understand this guy is more informed. He will trade more aggressively on her information. So they will be forced to trade less aggressively on their own private information. And that can gain the focal investor more competitive advantage. So that is good for her, and she will be incentivized to acquire more information. So that is third term. But for the pricing effect, the sign here is actually ambiguous. And what we find is that when the economy is close to a monopoly case, for example, when the number of investors is small, or when the cost of acquiring information normalized by noise trading is high, so that, okay, nobody acquired too much information, and their acquired private signals remain distinct to each other. So they sort of local monopolists. In this case, the pricing effect is negative. As in the monopoly case, it discouraged the overt investor from acquiring information. So whether the overt economy is featured with more or less information depends on the interplay of the 2 effects. And if we focus on the case with fewer investors, then they take the opposite sign. So which one dominates depends on which economy has more information production. So if C divided by sigma U is high, okay, so in this case, the 2 effects will have the opposite sign, and specifically, the pricing effect dominates. So in the overt case, investors are discouraged from acquiring information. So they acquire less information in the overt economy. And the opposite is true when this ratio is low. So this exercise teaches us that if a situation is actually a secret information acquisition, but the researchers somehow choose the traditional overt information acquisition models, then they may misestimate the amount of information produced in the economy. And further, we have 2 remarks to close this. So if we let the number of investors goes to infinity, we find that the 2 markets, overt and secret, actually converge to each other. And this means that the observability issue only matters for a small economy, okay? The second remark is that so thus far we only mentioned there is quantitative difference across the two markets, but there can also be qualitative difference between them. And as what we do here, we do the comparative statistics of information acquisition with respect to the number of traders. And if you use a overt information acquisition model, you may draw the conclusion that if we move from the monopoly to duopoly case, more information is produced. However, if the real situation is a secret one, then your conclusion can be wrong because actually less information is produced from the monopoly to duopoly case. So this again teaches us it's important to choose the correct model for our research purpose. And I think I stop here for.
Okay, so Liyan has been doing an excellent job at answering all the questions. I don't know that there's stuff to address here that Liyan hasn't gotten to like in a good way.
Okay, then I
yeah.
think it's fine. I can just move
let's
on.
proceed from here and and hope Liyan leaves some stuff for the end.
Okay, so far we take the observability as exogenous given. So an investor, whether it's overt or secret, it's exogenous given. Now we move on to endogenize this decision. So the motivation is actually, in real life, we observe some funds. They, in their advertisement materials, they disclose the profiles of their, say, mutual fund managers. And from that, we can infer like how strong this fund is. And also some like hedge funds, they try hard to erase their digital footprints. In that case, they make it secret. So motivated by these observations, what we do in this extension is that we add one stage in front of this economy. So at the stage -1, we allow the investors to decide whether or not to make their information acquisition observable or not, secret or overt. Okay, and again, we first check the monopoly case. And what we find is that for this monopolist investor, she always chooses the overt information acquisition. So her profits in the overt market is higher. That's the reason why she chooses the overt information acquisition. So the intuition is that, remember, for this monopolist investor, her primary concern is how the market makers responded to her information acquisition. And by making her information acquisition overt, she kind of commit to the market makers that she will not produce too much information, so you don't need to worry too much about me, and that can preserve her profits. So the monopolist investor prefer an overt economy, an overt information acquisition case. However, if we move on to a duopoly case, okay, for tractability issue, we can only examine the duopoly case. And what we find is that whether it's overt, or secret depends on this crucial ratio, the information acquisition cost normalized by the noise trading sigma u. So if this cost is low, then both of them choose overt. Whereas if it is high, then both of them choose secret. So look at this case first. If the cost is low, then it means that the investor have produced a great deal of information, and their information is so close, so the competition between them is very fierce. In this case, the competition effect is the salient effect. So by making their information acquisition overt, they commit to produce more information to build their competitive advantage. So that's the reason they prefer to choose the overt information acquisition case here. But if you compare the equilibrium payoff with this secret case, you actually find they are in a prisoner dilemma situation, and they end up producing excessive information, and they would be better off if they can just switch to the secret case. And similarly, we can analyze the economy with a high cost. Okay, so in this case, cost has been high, so they cannot produce too much information, and their information is distinct to each other. So now their primary concern is the potential response from the market makers. And they understand that if they make their information acquisition overt, and then the market makers will respond aggressively to that by setting steeper pricing schedule. And that means that by being an overt investor, they can only act conservatively. They cannot produce too much information. So in order to compete, they need to build a competitive advantage. So they prefer to be a secret to commit that they will produce more information to compete with each other. So they end with a secret case, okay? And one more step is that if on a voluntary basis, both of them in equilibrium choose the secret information acquisition, then those disclosure mandates that requires the investor to disclose their information acquisition is effective. Okay, it is effective because if without the mandates, they would choose the secret, but with the mandates, you can help them get rid of the present dilemma, so that can improve the investor payoff, improve the market liquidity coupled with the previous results. But the dark side of this kind of disclosure mandates is that it may reduce the market efficiency. Okay, so that's the main result. Let me conclude with three concrete applications. So the first application speaks to the regulation in Shenzhen Stock Exchange in China. And what they do is that in 2006, this stock exchange requires a listed firm to disclose the private meetings with investors within 2 trading days. So to map this into our framework, you can think that each corporate site visit can produce a private signal about the firm fundamental. And the number Hj of them can produce a series of private signal, and they are equivalent to the following information. Okay, so the precision of the information is denoted by small hj, the precision. So this setting can be interpreted as, with this disclosure mandates, okay, with the hj number of visits, then we can infer what will be the precision of the acquired information for this particular investor J. So again, I want to emphasize this disclosure mandates can be different from the traditional one because it has nothing to do with the realization of the private information. It just speaks to the precision of the private information. So to speak to this kind of mandates, we can say, okay, this kind of mandates, it is effective when this ratio is high. So the empirical proxy for this ratio can be the corporate site visits involve long traveling time, large expenses, or it is mostly traded by institutional investors so that the noise trading is low. And when it is effective, we can further study what will be the aggregate implications. Okay, so we find it affects the investors' information acquisition behavior. And it's worth noting, like one dark side of this kind of mandates is that it may reduce the price efficiency. Okay, so that's the first implication. The second implication speaks to the footprints of investors. So we have a lot of examples where people can infer can actually observe the footprints of investor, like SEC, Edgar downloading log files, the news clicks, or they file the Free of Information Act request to get information for the hedge funds, or they hire lobbyists to acquire information. And now those kind of data have been more and more available, and there are a lot of empirical studies using this kind of data. So to speak to this empirical studies, our framework actually said that before and after the availability of this data, the investor can actually behave differently. And if that's the case, then it can affect the inferences we draw from these empirical studies. So that's the first lesson. The second lesson is that maybe we need to think one step further. The reason why we observe the IP addresses of a certain sophisticated investor, maybe it's just deliberately left by them. Okay, so the data we observe can suffer from the self-selection issue. And we point out the pricing effect, the competition effect may play around that deal with the self-selection issue. So that's a second implication. The last implication speaks to the endogenous observability point. So we know that like hedge funds, those sophisticated investors, they always remain low key. So their research activities are generally unobservable. But there's one of the very exceptions. That is the participation in the firm's earnings conference call. So why do they show up in this public venue? Why do they show up at the risk of leaking their private information? So we provide a potential explanation for that. It's just a alternative perspective. So we argue that by showing up in those kinds of public events, then they can show to other rival investors of their interest in this firm and their involvedness on this firm. So by doing that, they force the other investors to trade less aggressively on their own private information. Therefore, they gain a competitive advantage. So this is just one potential explanation. And if that's true, our theory can further predict, okay, in what cases we are more likely to observe the buy-side participation in the earnings conference calls. So those are the three implications we have in mind so far. I think I can conclude with the last slides. So again, we argue that we believe that information acquisition is one of the very important decisions made by investors, and is one of the fundamental issues in finance research. So here we provide a very parsimonious framework to study overt and the secret information acquisition and their effects on the aggregate markets. So there are two strategic effects playing around that affects how much information is produced there. So they are the pricing effect and the competition effect. So pricing effect deals with the interaction between investors and the market makers. Competition effect deals with the interaction among investors. So pricing effect is novel to the financial market. And if we further allow the investor to make the information acquisition transparency decisions, we find that they may end up with a prisoner dilemma situation. Okay, so finally, we use our model to provide insights into the relevant policy debates. Like now, people talk a lot about investor privacy or the new data. Actually, people rely on this new data to do a lot of things, and our framework can offer some insights into those debates and the regularities. Yeah, so that's all for my presentation. Yeah, thank you.
Okay, thank you very much. That was an excellent talk. Okay, so Bjorn has enabled the raise hand function. So if you want to raise your hand, then I can let you talk and you can speak to Yan. So while we're waiting for like hands to go up, I had kind of a question of my own, which is about price efficiency in this endogenous observability case. So there's like, so mostly you focus on like the effects of liquidity, right? When you have this, like everyone gets shifted into this prisoner's dilemma box. But isn't that the case where everyone is over-investing in information, and so prices are more informative after trades, right? So is that true, that there's better price efficiency in this prisoner's dilemma case, which is bad for them in the payoff sense?
So you mean when the disclosure mandates are implemented, they move to over case, it's good for
before the mandates.
Before the
yeah.
In which case? Because there can
so
be
on the right side, for example, for a secret, is that the case where there's actually higher price efficiency because there's more investment in information?
Yes. Yes.
Okay. So there's like a, do you know what the trade-off is here between market efficiency and liquidity, and like how that should look in like a welfare sense?
So liquidity can be more subtle, but the efficiency is just a direct implication from the information production. So in the secret case, they actually compete very aggressively. So they produce excessive information. And that's the reason more information is produced in the secret case than the overt case. So if more information is produced here, then obviously the price efficiency is higher here.
Okay, cool.
Yeah.
Okay. We have a question from Albert here. Thank you for answering my question, by the way.
Hi, this was a great talk. I much enjoyed it. One thing that you haven't talked about, I'm not saying you should do this, but just to hear your thoughts about it, is the welfare type of result, where of course I think you focused the quality of the economy is how much information is produced by prices, is I think what you're doing, but another important yardstick to judge the quality of the equilibrium is the extent to which uninformed people can get their trades done. So that, you see the private value realization. And typically, if you have a very informed market environment, given that ultimately the uninformed people, the noise traders, pay the cost, there might be less noise trading and therefore less private value realization. Can you comment on that? It's just to hear your thoughts. Again, it's not to suggest you should do the analysis, but you probably have ideas. I've thought about it.
Actually, we have that result I didn't present here. So in the presentation, I focus on the market quality, but for welfare, actually, we have that set of results. So if after the information acquisition, after the cost have been incurred, then this is a zero-sum game, right? Because it's just the like the gain of the traders is the loss of the noise traders. So the welfare implication we have here is that, so by implementing such mandates, we move from, say, secret to overt case, then we help the investor to prevent from producing excessive information. So that can be welfare improving. Yeah, so that's another implications here. It can be welfare improving in this case when the disclosure mandates are effective. But that's a good suggestion. We should probably emphasize more on it.
Yeah, thank you very much.
Yeah, thank you.
Okay, I thought I saw another question at some point, but no, I don't know where that question went. I guess the question got answered at some point.
Maybe get killed by Liyan. Okay.
Yeah, Liyan is out there crushing it. So does anyone else have any other questions? This is a good time to ask because I don't see any hands right now. Let's see. Yeah, there was, oh, here we go. It's Peter Lerner. Peter Lerner saves us again. Okay, you should be able to unmute yourself, Peter. Okay. I'll leave your, Peter, I'll let you like try and unmute yourself if you can, and then you can just interject at some point. There was an interesting discussion that Liyan was having with, I can't remember who at this point, about incentives to lie about your information disclosure. Mm-hmm. So, you know, you can, in this case, it's strictly, if you're an over investor, you have strictly credible information investment. But do you have like thoughts on whether or not it would be interesting to study incentives to lie in this case about how much you're investing, whether you're doing it overtly or secretly?
We haven't fully thought about that, but it can be an interesting extension. So the point is that I actually I do something, but I lie to others that I acquire high precision, but I lie to others that I just acquire a low precision signal, right? If
Yeah.
that's the case, that can be interesting. We need to think more about that. But thank you for the suggestion.
Yeah, that wasn't my suggestion. It was somebody else. I can't remember.
Okay,
Peter,
thank you.
it looks like Peter's unmuted. Did you want to go
Yes, I'm sorry that I muted myself. It seems that mandatory disclosure is effective, as you said, when cost of acquisition of information is high, right?
Yeah.
Because in commodity markets, the cost of acquisition obviously is higher than an equity market, because it's not only information immaterial, but also material information like tankers in the sea, whatever. So it would suggest from your theory that commodity markets have higher investor payoff, a lower liquidity, and lower market efficiency, which is probably true.
Oh.
So it's
okay. Commodity market.
yes, they have much higher, they should have much higher cost of acquisition of information, right?
Right.
And your theory will predict that investors get higher payoff, that market liquidity is lower, and market efficiency is also lower, which is intuitively correct.
Okay, thank you. We don't know that. We have, yeah. This is cross-market comparison. Right.
Okay.
Yeah, thank you. Thank you for pointing out to this direction.
Okay, thank you, Peter. Okay, I don't see any further hands unless somebody's got one. Oh, Albert's back. Hey, Albert.
Yeah, yes, I'm here again. So just a clarification, you caught my interest. So you said that the SEC is producing information on the number of downloads of their of the documents that they keep in the repository, and what more information do you see? Who's downloading, or from what domain it's being downloaded? Yeah, just on my private interest.
Yeah, there are several papers on that actually. So you can have a Edgar downloading log files, and you can see the IP addresses. So for the last 3 digits, it have been erased. But those smart guys, they are able to kind of link that to certain investors and to back out who downloads at which point in time and what have they checked, and so those kind of information have been available there. So one issue like bring that into our framework is that maybe next time when the investors realize someone is keeping an eye on the downloading files, they may use a VPN to hide it, or they just deliberately leave their footprints there.
That's right. So this comes back, yeah, to the issue of lying or no, right? Because it's easy to produce a bot if you're smart enough that just checks. If you think it's important for you to believe that you're super informed, your bot can just check every day at a random time, and you show up with your address a lot. So I wonder how much information there is in there. But so I'm sorry, I haven't read the paper that Chen et al. What do they find? That it is indeed useful to useful information?
Yeah, I think so, because if I remember correctly, they track this IP address and their downloading of, say, insider trades, and they find like by regularly checking this information, they do gain more profits from it. And there's another paper. What they do is the question is that for the hedge funds, so this kind of information is arguably public information. So their question is that will hedge funds make profits by using this kind of public information. So that's another paper. But there are, and also there is an accounting paper. What they do is to check the federal board's people to check their downloading behavior on this SEC Edgar and to see how that affects some macro policy. Yeah.
Very interesting.
Yeah.
So will the microstructure exchange produce statistics on how often people log into to the microstructure exchange, and does that help with the visibility of the paper? Gets me thinking about lots of issues. But thanks a lot.
Thank you.
Okay, thank you very much, Albert. Does anyone have additional questions? I don't see anybody in the queue. Okay, cool. Thank you very much, Yan. This was an excellent talk. Thank you, everybody, for questions. Thank you, Liyan, for answering everything in the Q&A. So in 2 weeks, we're going to have Edwin Hu. And then you don't have to look at my face anymore because somebody else will be moderating, and that'll be nice for everyone involved. Okay, so thank you very much again, Yan. Everyone, please give her a silent round of applause at home. And everyone have a lovely day. Or night. Go to bed, I guess. Because I don't know what time it is anywhere.
Yeah.
All right, bye.
Bye, thank you.